We now move on to the main program, and here to get us started is Whitney Curry, a remarkable young lady who only graduated from college 4 years ago at the University of Washington studying communications and business. Whitney, in that period of time, has already served on the board of the YMCA of King County. She's interned at Mercer Human Resource Consulting and the University of Washington Alumni Association. 4 years ago, she joined Zillow, has worked in the public relations area, and is today responsible for their social media activities. Please welcome Whitney Curry.
Well, Dr. Stan, as we affectionately call him around the office, or Dr. Stan Humphries, is the chief economist at Zillow, the leading real estate information marketplace. Stan joined Zillow as one of its founding employees back in 2005 and is the mastermind behind the Zestimate, Zillow's estimated market value for your home, a data point that may or may not have ebbed and flowed a bit over the past few years. In addition to all things Zestimate, Stan is in charge of the Zillow Home Value Index and the Zillow Rent Index. Stan built out an industry-leading economic and analytic team while at Zillow, and on an ordinary week, you may find Stan and some of his team members doing everything such as testifying before a Senate subcommittee on housing, appearing as a guest on CNN, Fox News, Bloomberg, commenting on Zillow's latest housing numbers, drafting an op-ed for the Wall Street Journal, or tweeting. If you have an account on Twitter, please follow Stan. He's at Stan Humphries. Stan has a PhD in government from the University of Virginia, and prior to joining Zillow, spent 5 years at Expedia. If that wasn't enough, Stan has also worked for NASA and was a part of the Peace Corps in the West African country of Benin. Whew, that was a mouthful. So take it from here, Dr. Stan.
Thank you, Whitney, for that gracious introduction. And Zillow would not be half the place it is without people like Whitney, who's been here been at Zillow for quite a number of years. And also thank you to the Rotary Club for inviting me to come speak today. I'm delighted to be here. Happy birthday, Jim. That's fantastic news, and fantastic job, Sue, on the song. I was very impressed. So I'm delighted to be here in no small part because of the fact that the housing market is now in a little bit of a different place than it has been over the past 5 years. Zillow was actually hatched as an idea just a few blocks away from here in the Second Union Building back in 2005 by our founders Lloyd Frink and Rich Barton. And then we launched a website in early 2006, February of 2006. And we've grown. Our business has done quite well over that intervening time. Although the housing market, during most of our corporate history, the housing market is done quite poorly, as most of you know, during the housing recession. But we see some signs now for some optimism on various fronts, which I'm going to speak to you about today. So it's been difficult, I think, over most of our corporate history to. When I talk around the country to various groups about what's happening in the housing market, usually it's a very somber. It's a very somber presentation, and it can be very dour, and so I'm delighted to have a little bit of a more positive market sentiment to talk about today. So in order to do that, I'm actually going to use the slides. I don't know if we could turn the projector on. That would be great. It's a little bit hard to. It's easier to speak through data with some charts and graphs. So what I am hoping to achieve today, and in speaking with my other members of my table, it occurred to me that I usually give talks about the housing economy and how it fits into the overall economy and what we're seeing in different markets. But it sounded like there was a lot of interest as well about kind of the business of Zillow itself and Zestimates and other things. So I'm going to try to keep my remarks to about 15, 20 minutes and leave enough time for some questions afterwards. So if folks want to ask me things that are non-economic related and more related to Zillow's business or Zestimates or the products that we have, I'm happy to entertain those questions as well. But in that short amount of time I have with you, I'm going to try to give you just a thumbnail sketch of what we're seeing in terms of the national housing market, and then give you a few tidbits about what we're seeing in the local Seattle market as well. So with that in mind, looking at the nation first, essentially the housing recession has been really a wrenching affair for the United States. It's been unprecedented. We used to say that the housing recession was unprecedented in the post-Great Depression era, and really that's, by all accounts, no longer true. The extent of the housing recession from its peak in 2007 has been that home values have declined at this point in excess of 25%. Now that's excluding foreclosure transactions. If you were to include foreclosure transactions in your housing index, the decline from peak would look more like 33%. We think, by our best available evidence, that the Great Depression saw home value declines in about the 23% range, making the current housing recession worse than even the housing declines we saw in the Great Depression, which is particularly sobering. Now, of course, what happened in the broader economy is much worse in the Great Depression, but the housing market was spared some of the wrenching downturn that we've seen in the most recent recession, because back in the 1920s and 30s, down payments were much more substantial than they were today, which led people to not have as much negative equity as we have today, which led to fewer foreclosures, we believe. So suffice it to say that the current housing recession has been really unprecedented in really the modern era. I should just point out that besides courtesy of home values declining 25% from their peak, that's pushed nationally home values back to where we last saw them in 2003. So really we're looking at about a lost decade at this point in terms of home value trends. That's translated into an enormous amount of housing wealth being erased from basically the household balance sheets of Americans around the country. If you look at the worst year in terms of the loss of household wealth was in 2008, when we lost, in 2008 we lost $2.7 trillion in housing wealth. Last year alone we lost just under $900 billion in housing wealth. And all told, over the course of the housing recession, we've lost over $7 trillion of housing wealth. This is a key reason why I'm sure you're aware when we talk about the broader economic recovery and how it's proceeding. We describe it as really a slow motion recovery and a fairly tepid recovery judged against other economic recoveries in the past. A key reason why this is so is because of this very fact that so much household wealth has been erased from Americans' balance sheets. It has tended to stunt consumer spending and has made the recession, the broader economic recession, a little bit slower to get out of than it would otherwise. Because what happens when people lose this amount of wealth is they tend to dial back their spending in other areas in order to increase their savings for retirement or for other needs. So this has what's called a wealth effect, where because you feel less wealthy, you tend to dial back spending to build up that wealth again, and this has definite implications for the pace of the housing recovery of the broader economic recovery we're seeing right now. The other thing that's particularly impressive about this current housing recession that we've endured, and that hopefully we're now coming to the end of, is really the not only the magnitude of the recession, which I've already described, but really the breadth of it. We've had regional housing recessions, plenty of them. We've had, Boston seems to have them about every 20 years. We've had a bad recession in Texas and in the 1980s. In Southern California, the early 1990s saw a fairly bad housing recession. But really, in terms of, all markets have been affected during this current housing downturn. This is a decline from peak in various metros, and you can see metros like Phoenix down almost 60% from its peak. Vegas and Florida and California markets down similarly, just very staggering amounts of home value loss there, as well as Detroit having very high rates of home value loss. So really a very broad-based housing recession. This magnitude of home value declines inexorably leads to negative equity, which is the condition in which the current value of the house is less than the mortgage that you have on the house. And this is something that really negative equity is something that rarely occurs, because typically in the U.S. home values increase, and therefore we don't see much negative equity. Currently, as of the third quarter of 2011, by our estimates, we had about 28% of people with a mortgage that were in a negative equity condition. Just a staggering number. And in many markets like Vegas and in Phoenix, that number is north of 60%, sometimes as high as 80% of homeowners with a mortgage that are in negative equity. Negative equity is not an academic problem because, of course, it translates into foreclosures. It creates a latent vulnerability where the household is in negative equity, and so if they run into a hiccup of a death, a divorce, a cutback in hours, something that creates some economic shock to the household, it makes it much more likely they're going to go into foreclosure because they can't sell the house because it's in negative equity. Foreclosure sales as a percentage of monthly sales, just to give you some sense for how saturated markets are currently with foreclosures. You can see that most markets have, well north of 1 in 5 or 1 in 4 homes that are sold each month are foreclosure resales. Foreclosure resales are damaging to the housing market for two reasons. One, they introduce new supply into the marketplace, and supply, other things being equal, push down prices. The other factor with foreclosures is that they're not only more supply, but they are cheaply priced supply. They are priced at typically about 25% below a non-distressed home. So they doubly serve to push down prices. So really the conundrum that we've seen over the past year and a half in the housing market has been this. So I've described the trajectory of the housing recession and how wrenching it's been. And I probably don't need to dwell much more on that. I think we've all felt how bad the housing recession has been. Really the interesting phenomenon in the past year and a half has been why, given such radical home value declines and such low mortgage rates, has just not gotten people off the fence to actually wade back into the housing market. So what you can see here is the black line is housing affordability, basically measured. It's looking at the amount of your monthly income that it's going to take to buy a home. And with home prices nationally pushed back to 2003 and 4% mortgage rates, those two factors combine to create affordability, which really we have not seen in about 30 or 40 years. Homes are that affordable. It's just insanely affordable to buy a home right now. Just anecdotally, we sometimes have these conventional wisdoms in real estate of, don't buy a home unless you're going to be in it for 5 years because it doesn't pay for the transactional cost and the other costs associated with that sale. In Detroit right now, you could buy a home and plan to live in there for fewer than 2 years, and you would be net flow positive on that transaction. That's how cheaply priced homes are relative to rents in Detroit. It's amazing. Detroit has had such a reset in home values. But the amazing thing is that despite that, the orange line is total home sales. So you can see that the black line has gone through the roof. We've had historical affordability, but still we haven't gotten people off the fence to buy homes. Now the reason for this, we believe, is twofold. One is the general softness in the economy itself. People tend not to want to go out and buy homes when they're worried about unemployment or their jobs. The other is that no one wants to catch a falling knife with home values falling. So because home values have been falling so quickly, consumers aren't going to want to buy an asset that's going to lose value substantially after they buy it. So this is, we believe, kept buyers on the fence instead of wading in to buy homes. Until recently. More recently, we're starting to see this improve gradually. So here are the trends that we see combining into an improving picture in the overall housing market. The top line is the unemployment rate. So we are seeing some good improvement in the employment rate. Job growth monthly now is, well, it had been more than 200,000 jobs created each month. Last month it was just over 100,000 jobs. But we're seeing some decent job growth there. We're also seeing the next line, the blue line on the chart, is change in home values. So we're seeing home values, the annualized decline in home values is slowing. So we're coming to, homeowners could arguably, and buyers and sellers could arguably see a light at the end of this tunnel. And that has combined with some lag in the last line, the orange line, which is consumer confidence. You can see that as unemployment has improved and the pace of home value declines has improved, we're seeing consumers feel a little bit better about the economy. And predictably, this is starting to actually be translated into a thawing of buyer confidence and homeowners or home buyers getting into the market to buy. The orange line there is existing home sales, and the green line is new home sales. New home sales are still largely decimated because of a lot of foreclosures out there that compete with the new construction product, and the fact that existing home sales are so cheap. But existing home sales, we are seeing with some toggles there, some ups and downs. We're seeing fairly good traction in terms of starting to grow sales more recently. We think that 2012 is actually going to be quite a good year for existing and new home sales, as well as housing starts. We think that 2012, because of the broader economy starting to improve and home value trends themselves starting to materially improve, we think that buyers are poised to get off the fence in 2012, and we think we're already seeing that in the first 3 months of this year, where we've seen home sales be up anywhere from 8 to 12% from where they were last year. So we think that's encouraging news. Unfortunately, a lot of these sales that are going to be occurring are foreclosure resales. That's just the nature of negative equity being out there, that we're still going to have elevated foreclosure rates. So while we're having elevated sales, a lot of the sales are still going to be cheaply priced foreclosures, which is going to put some downward pressure on homes. This is actually a forecast from 3 months ago. We're just releasing our next forecast on Tuesday, which is a little bit rosier, actually quite a bit rosier than this one, but it's not public yet. But as of 3 months ago, what we were forecasting for the U.S. level was home value declines across 2012, the calendar year, of about 3% decline in home values across this year, with a bottom being definitively nationally in early part of 2013, although many markets, we believe, are going to be seeing a bottom this year. Markets like Phoenix and Baltimore, Washington, Miami, Tampa, L.A., and we'll talk about Seattle in just a moment. We're actually going to post these. In the interest of time, I'm going to move more quickly through some of these, but we will post these, and then I think we'll be able to send you around the link to where you can have access to the full presentation. But what I wanted to show here was the fact that while we spend so much time talking about metro level numbers of what's happening to Seattle Metro and LA Metro and DC Metro, if you really want to see the housing recovery, the story is really occurring on a very micro level. What you're seeing here is basically the zip code trajectory of home values in the Phoenix Metro in 2 periods of time, in early January of last year and by the end of the year in December. And even though by the end of the year home values fell 3.1% in Phoenix, in the start of that year, I think it was about 18% of zip codes we're seeing, only 18% were seeing positive appreciation on a quarterly basis. By the end of that year, 87% of zip codes were seeing positive appreciation. And this is still not yet been translated fully into the year-over-year numbers. So while we still talk about year annualized numbers, which seem bad, the recovery is actually quite visible if you look at the lower level. This is Miami. Same trend there. A lot of blue, which is indicating blue is zip codes that are not appreciating. Red is zip codes that are appreciating. So by the end of the year, even though Miami Metro is still down overall, we're seeing a lot of zip codes in very good recovery mode. San Francisco, same thing, down 5% for the year. A lot of blue on the left. And by the end of the year, a lot of the peninsula and the Bay Area is now seeing nice recovery. And then Detroit, really hard-hit market. Same thing, a lot of blue on the left, moving to a lot of red by the end of the year, even though the annualized numbers are 5%. So we think that, at Zillow, I guess it's always been our mantra that, to understand real estate, you really have to be very local about it, and that's why we've prided ourselves in, free data of housing indices down to the neighborhood and zip code level, and we think it's so local, of course, that we will tell you what we think is happening to your individual home's value over time as well. So we definitely think that people should understand what's happening locally. Real quick, what's happening in Seattle? Seattle has actually had a little bit of a more stronger housing recession than the overall country, but in terms of hard-hit markets, coastal markets, it's actually had about a pretty average housing recession. Seattle from peak. Now Seattle here is not the city. The city's actually done pretty well. It's the 3-county area. It's Snohomish, Pierce, and King County. Those 3 counties overall are down about 33% from their peak. Remember, the country's down about 25% from its peak, so a little bit more than the nation. But remember, most of the nation didn't see much of a housing recession at all. If you look at Wisconsin and Texas and Oklahoma, those parts didn't see much recession at all. So to think about where Seattle lies in terms of the other big metros, really we're having about a middling housing recession compared to others. We're no Phoenix or Vegas or Miami, where their home value declines have just been enormous from peak, more than 55 to 60% of home value loss from peak. But by the same token, we're no Dallas or Denver either, who've had very mild recessions. We've had very much of a middling, recession. We're in there with kind of, Chicago's and San Francisco's. So a very typical housing recession. These are some other metrics we're going to track. I'm going to kind of gloss over these. Seattle price to income ratio. Again, this is the 3-county market. We're roughly back into alignment with our long-term historical average for price to income. Price to income is a way that economists look at markets to figure out whether they're overvalued, because it tells you what do people typically spend on a house relative to their monthly income. And if you look at that, that's that black line across that chart. You can see we really got out of whack with what people spend typically on their homes during the housing run-up, but largely we've reset that exuberance during the market bubble. Now to actually break down that market, again, the theme being that to understand the market, you really have to be quite local. You can see that King County and Kitsap, I threw in for a good measure, have had much milder. What you're looking at here is actually year-over-year change in home values. Pierce and Snohomish have really borne, it's been a different housing recession to the north and south of our metro, much more severe than in King County itself. That's actually been translated into the foreclosure levels, which are much higher in Pierce and Snohomish. And then to give you a sense for kind of where Seattle kind of stacks up relative to the rest of the country, what this chart is showing you is everything that's green on this chart is areas that their decline from peak has been better than Seattle Metro. And red is every place that's been worse than Seattle Metro. So you can kind of use this to figure out who's had a better ride during the housing recession, who's had worse. And you can see California, Vegas, Phoenix, Florida, Detroit all having worse than us. If you zoom in, so now same color, so red is better, red is worse than Seattle Metro, green is better. So now we're kind of moving into the northwest, and you can see that kind of what that pattern looks like. I'm going to zoom in one more time. So this is actually zooming in now to kind of the middle of that map is Seattle itself. And you can see that there's a real pattern here of basically there's a corridor from about Magnolia out past Sammamish almost to Snoqualmie and North Bend, where economists call this in the various markets. You see this pattern replayed in a lot of markets around the country. This is oftentimes referred to as a favored corridor, where that corridor during recessions doesn't see the same patterns as the rest of the market. Our favored corridor is really from Magnolia out past Sammamish to Snoqualmie. That's that green band in the middle. If you go south of that into Renton, Auburn, and then down into Tacoma, or you head north of that, the area north, you get much more housing, you get more declines in value in terms of, so a worse housing recession. And then if you zoom in, I'm now going to switch the scale of this. So now green is actually positive appreciation. So it's not better than the Seattle Metro. It's just, is it positive or not? And red is whether it's negative. And here you're zoomed in, kind of looking right at kind of the Seattle core. So again, you can kind of see that pattern of some of those red spots that were green in the old map. They're places that are doing better than the Seattle Metro, but they're still seeing modest declines. But you can see a lot of green in this map. That means these are places from Seattle and kind of around Bellevue and up into Kirkland and in that area that are actually doing quite well even now, even while we report Seattle Metro doing quite poorly. If you listen to Case-Shiller or even our own index, you think about the Metro, it's a very different picture from what's happening locally. Interesting phenomena we see not only in our market, but a lot of the key markets are that home values have held up better in more expensive areas. So the higher the median home value in your city, the more likely it is that city has had less decline from peak. So you can see Medina is the far out right point down there, and as you head down to the left, the lower home values have seen more of a housing recession. So unfortunately, the housing recession has not been fair in its treatment of various cities. I think I'm going to stop there. Basically, our outlook is we declined nationally about 5% in 2011. We think we're going to see further modest declines nationally in 2012. Those declines are going to be sending a mixed message, because generally, in terms of sales, we're going to have a pretty positive market in 2012, we think. Both existing and new are going to do quite well, and we think we're going to see a fair bit of housing construction this year. Even though we're going to see some modest home value declines in a lot of markets, including the Seattle market, we're going to see a lot of markets that are actually going to bottom this year, which is good news. So I think I'll stop there and I don't know, Jim, do I have a couple questions? Okay. Yeah, right back here.
We'll start right here.
Thank you, Faith. So how does Zillow generate revenue, and how are you profitable if I'm an investor with you?
Sure, yeah. So Zillow is a media company, so we make our money entirely off of advertising. So, and that breaks down into about 60-70% of our business is what we call marketplace advertising, which is brokerages, real estate agents, and mortgage lenders and brokers who advertise on our website. The other 30% of that revenue, 30 to 40%, depending on the month, comes from what we call display advertising. So that's traditional advertising like GM or Chevy or Pottery Barn advertising, display advertising on our website. But it is entirely advertising based. And your second question was, how do you make money if you invest in us? Is that, did I answer that?
If I'm an investor, I want to make sure you have a good revenue.
Yes. Well, we are profitable. We were profitable starting in the, I believe, the summer of 2010. So we're doing fairly well. And we're a public company, so of course our quarterly statements are publicly available.
When median home prices get reported, as say they're down 3% or something, what portion of that is attributable to people just buying less expensive homes versus actual declines in the value of those homes? Wow,
you know, I never get that question, and I've always wanted to get that question. So thank you. Wow. So do we have another 15 minutes? That's a great question. Typically, when you look at housing indexes, particularly median sale price, the problem that you described, so what he's describing is that, let's say that home values haven't changed at all, but just more low-priced homes sell in that month, that will pull down a median sale price index, even if home values themselves haven't changed at all. What we do with our index, which was designed to exactly solve that problem, is it is based by looking at the valuations on all homes. So essentially what we're doing is we're simulating if every single bit of housing in the housing stock sold on a given date, and we estimate that 3 times a week, and then that's what we create our housing index off of. So by doing that, that essentially statistically adjusts for a change in the mix in housing. So we've had plenty of changes of mix in housing during the housing recession, during the federal home buyer tax credits, which were $8,000 up to $8,000 for people who wanted to buy a home. That really shifted you saw a lot more lower priced home sales during that period of time, which if you were looking at a pure median sale price index would be tainted by that. But our index instead adjusts for that, so it's looking at basically all homes, regardless of whether they sold or not.
Can you tell us a little bit about your estimate and how you can have a pretty wide disparity between houses that are next door to each other that objectively, based on lot size or square footage, might be quite comparable?
Sure. Yeah. So, you know, I think the important point when thinking about the Zestimate is that the Zestimate is a machine learning algorithm. It is a statistical model that is designed to take the inputs from recent sales and then detect patterns in those recent sales, and then what it's learned in those patterns apply it to all other homes. There are a bunch of different inputs that go into that, into those models, and those include home attributes, bedrooms and bathrooms, square footage, as well as the geospatial location, where is that home located, prior sale prices, tax assessment information. In all, it ends up being probably about more than 200 different inputs go into, for each home, go into that model. Now the model is imperfect. I mean, when we talk about the Zestimate, we think of it as really a starting point for having a conversation about value. So it's not the definitive word. We haven't seen the house. It is a model that has what it has to work with is the public facts we know about the house. Now, for homes that are identical to each other and are sitting next to each other, reasons why that algorithm may get confused and price one a little bit above the other one would be, for example, if those two homes sold at different times and at different prices, the model is trying to figure out, I have two identical homes, but one seems to have sold at a higher price than the other, or maybe the tax assessment is different on those. It's looking at all those bits of information, and there's something that will lead it to think that one home has more value than the other based on those inputs. Even though, because I think consumers think about it as the only inputs would be square footage, bedrooms, and bathrooms, but the model is actually looking at a lot more, and more than likely for those two homes where they're confused, those inputs vary somewhat, and that's what's caused that discrepancy.
Seattle Rotary Online is made possible in part by a grant from First Choice Health, working with the Washington Health Information Collaborative to use technology to bring better health care to patients throughout the Pacific Northwest. First Choice Health.